The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. Welcome back, everybody, to Trajecta Talks. I'm your host, Alex Savanovic. For those of you who are new, I'm an experienced hedge fund trader, and this podcast is all about demystifying the world of finance for you, the next generation of leaders, innovators, and investors. I'm so glad you're here, whether you're listening in your dorm room, on your way to class, or just trying to figure out what's next after high school. My goal is to equip you with the knowledge and confidence to build a solid financial foundation and make smarter money decisions. So, in a previous episode, we touched on the basics of debt, and today we're taking that conversation to the next level. This is the advanced course on debt. A look at how it can be used for significant good or cause immense harm, and how that equation changes depending on whether you're a person buying a home or a seasoned investor leveraging millions of dollars. But before we get into today's episode, you know it's my favorite part of the episode. Let's go through what we were seeing in the markets this week. So this week is proving to be a busy one for the markets, with major headlines spanning initial public offerings, corporate news, and significant shifts in index composition. So while the Federal Reserve's next move remains a key macroeconomic factor, the headlines of the past few days have been dominated by company-specific catalysts and a notable shift in global capital. The IPO market is roaring back to life. While we are keeping a close eye on the pipeline, we saw significant developments. Klarna, the buy now, pay later giant, priced its IPO at $40 per share, which was above its initially stated range, signaling robust demand from investors. This is a very encouraging sign for the broader market. Another deal that has been generating significant buzz is Gemini. The ticker on that is GEMI. Also, the ticker on Klarna is KLAR. Now, back to Gemini, which is also poised to go public. Looking ahead later in the week, we've got Legence, that's LGN, VIA Transportation, that's ticker VIA, and Figure, FIGR, which at the time of this recording, Figure just went public today. I think opened at 36. They priced it at 25. They're all coming this week, setting the stage for one of the busiest periods for new issues in recent memory. So moving along from the IPO market, a handful of major announcements have captured attention. So in the AI space, Nebius Group, that's NBIS, made a huge splash with the announcement of a multi-billion-dollar AI infrastructure deal with Microsoft. The news was met with a very strong market reaction, with NBIS stock surging on the back of the news. Meanwhile, the S&P announced that Robinhood, ticker on that one is HOOD, or Hood, and AppLovin, APP, will be added to the S&P 500 effective September 22nd. This is a significant milestone for both companies and is expected to drive institutional buying as passive funds rebalance to track the index. So we haven't talked about Elon Musk in a while. On the satellite front, some of you may have heard a major deal was announced between Starlink, which is Elon's company, and EchoStar, formerly SATS, in which Starlink is acquiring EchoStar's spectrum for approximately $17 billion. This is a landmark deal that will help Starlink expand its direct-to-cell services and further position it as a competitor to traditional mobile carriers. Now, interestingly enough, we saw a lot of those other mobile carriers get hit all week on this news. And amid all the US market activity, a quiet but notable trend is emerging with Chinese equities following a period of underperformance. China stocks are showing signs of life and have had a very strong week, outperforming US indexes. We've been watching the Crane Shares China Internet ETF, KWEB. KWEB is the ticker, very closely, and its recent positive performance could signal a rotation of capital into these stocks as a result of recent government policy and a shift in market sentiment. And today, at the time of this recording on Thursday, at market close, I can't remember how much BABA was up exactly. That's Alibaba, but amazing price action today. That wraps up our segment on market news for the week. So today, let's get right into the episode. We're going to discuss the positive uses of debt and delve into the pitfalls of irresponsible borrowing and explore the different mindsets around debt for individuals versus investors. This is a crucial topic because understanding the nuances of debt is fundamental to building long term financial stability and wealth. So let's get right into it. So I want to start off with a little bit of a shift in perspective. Too often, I think debt is seen as an enemy. The word scares people. While high interest consumer debt can certainly be a destroyer of wealth, debt itself, when used strategically and responsibly, is one of the most powerful tools in the financial world. There's a huge market out there for debt and debt related instruments. It allows you to acquire assets that you couldn't otherwise afford and to create leverage, which is a key concept that we're going to talk about today. Now, the most common and arguably a lot of people feel is the best use of debt over a average person's course of life is a mortgage. And a mortgage is a loan used to buy real estate. We've talked about it in a bunch of other episodes. So why is this considered potentially good debt? Because you're using borrowed money to acquire a valuable asset in most cases, your home that will hopefully appreciate over time. Instead of paying rent, which is money you'll never see again, you're building equity in an actual asset. So you're also leveraging the bank's money to control an entire property. So for a relatively small down payment, I would never, minimize the down payment to 5% because if the value of your home goes down, your equity portion might get wiped out. But for a down payment of 20%, you can control a home worth 5 times that amount. This is a form of leverage that allows you to participate in the real estate market in a way that would be impossible with cash alone. Another example of positive debt is potentially a student loan. And this is an investment in your human capital. A university degree, while it is expensive nowadays, can lead to a career with higher earning potential, more opportunities, and more of a stable future. While we must always be mindful of the cost, a student loan is an investment in a future asset, which is your ability to generate income. It's a loan that helps you acquire skills and knowledge, which are often the most valuable assets that a person can have. Let's move along and talk about small businesses. For a business owner, debt is often the fuel for growth. A small business owner might take out a loan to purchase new equipment, expand their storefront, or invest in marketing to acquire new customers. This debt, when used wisely, can lead to increased revenue and profitability, allowing the business to pay back the loan and grow its net worth. So the key here is that the investment generates a return greater than the cost of the loan. And you want to make sure that that checks out before you do any of this. And it's similar thinking when we spoke about a student in university. You're not going to take out a loan for 100,000 and go and get a degree where it's very difficult to get a job that's going to pay that amount back in your future. The thread that ties all of these examples together is that the debt is used to acquire an asset that has the potential to either generate income or appreciate in value. This is the hallmark of good debt. So that was all the positives. We started out with the light, fluffy, good stuff. Let's move on to part two, where we're going to talk about the perils of irresponsible debt use. So, irresponsible debt, or what many people refer to as bad debt, this is the money borrowed to purchase things that lose value quickly or to fund a lifestyle beyond your means. So, the most insidious form of bad debt is high interest credit card debt. Credit cards are fantastic tools when used responsibly, allowing you to build a credit history and earn rewards, potentially based on the card that you have. Every card has some different reward system. But when a balance is carried month after month, the interest charges can be crippling to your future. Credit card interest rates can be as high as 20% or even more. And if you're only making the minimum payment, you're often just treading water. I would argue maybe even drowning, paying off interest while the principal barely moves. You're essentially paying a premium to buy consumer goods that lose value the moment you walk out of the store. So let's just use an example. Imagine you charge a new flat screen TV on your credit card for $1,000. I know they're not $1,000 anymore, but let's just use that for simple numbers. With a 20% interest rate and a minimum payment of $25 per month, it could take you over 4 years to pay off, and you would end up paying over $1,400 for that TV. This is the definition of irresponsibility. You're paying for today's convenience with tomorrow's financial freedom. Irresponsible debt often leads to a debt spiral, and this is a vicious cycle where you take on more debt to pay off existing debt. This could look like taking out a payday loan to cover a credit card bill or using a personal loan to consolidate overwhelming balances, only to rack up new charges on the credit cards. This path leads to a situation where your monthly payments are so high that you have no room to save or invest, and a single unexpected expense can push you over the edge. So, the difference between good debt and bad debt is often defined by the purpose. If it's used to acquire a growing asset, it's good debt. And if it's used to buy depreciating goods, it's bad debt. Now, I want to apply just one asterisk here. Buying a car. Everybody knows that when you purchase a vehicle, the minute you drive it off the lot, it loses value, which is completely true in 99% of cases. There is that one small 1%, maybe even half a percent of cases where some folks will spend an exuberant amount of money on a vehicle that is actually quite rare, and maybe it's a limited edition, there's very few of them in the world. I can only speak to there was a Ferrari model many years ago. I wouldn't even say it's many years ago now, probably about a decade. Um, you could purchase, I want to say was initial price was $2 million dollars, and the last one sold for $4 million dollars a few years back. So that's an example of an asset that if you purchased it on day one, it obviously appreciated in value as it relates to cars. Now, most cars, that's not the case. I would say if you need a car to do your job, for example, or maybe purchased a truck for you need to get to work, there's so many different reasons that you might have to buy a automobile to carry out your life and maybe even go earn more money. So I would put an asterisk on all bad debt is for assets that depreciate in value, because that would be true in the case of a vehicle most of the time, but you might be using that vehicle for something useful. So there's a little bit of nuance there. So now that we sort of understand the difference between good and bad debt, let's talk about how to manage it. This is a practical, step-by-step guide. We're going to take it easy for any individual struggling with debt. We're not going to get into too much detail here because I know I've talked about some of this stuff on my first debt episode, but we're just going to cover it briefly. So the first step is to get a complete picture of your financial situation. You need to know exactly how much you owe, to whom you owe it, and at what interest rate. List all of your debts: credit cards, car loans, personal loans, student loans, anything and everything, and include the total balance, the interest rate, and the minimum monthly payment. So this will allow you to prioritize which debt to tackle first if you ever find yourself in a situation where it's just piling and piling on. So we talked about snowball methods and avalanche methods on the first episode. Go check that out. That sort of helps you eliminate the debt. You decide which method works best for you. Next, most important part is you got to create a budget that prioritizes debt repayment. So look at your expenses and identify areas where you can cut back to free up money to throw at your debt. Additionally, you need to create an emergency fund or sinking fund, which is a small savings account to cover any unexpected expenses that might arise while you're tackling this debt. This is vital to prevent you from using a credit card and falling back into debt the moment a problem arises. So, for investors and corporations, debt is viewed through a completely different lens. It's not about buying a new TV or going on vacation. It's a strategic tool for leveraging capital to magnify returns. In addition to that, I know we talked about mortgages, but let's look at it from an investor's perspective. An investor might buy let's say, $1 million property, a commercial property with a $200,000 down payment. So that's a 80% loan to value. The property has a net operating income, or NOI, of 70 grand per year. And after mortgage payments, property taxes, and other expenses, the investor's cash on cash return might be even higher than the initial cap rate because the return is magnified on a much smaller capital outlay. So, for example, a property that generates a 7% cap rate might produce a 10% or 12% cash on cash return on the investor's initial cash investment, all thanks to leverage. However, the risk is also magnified. If the property's NOI drops or interest rates rise, the investor could lose the entire property and their initial investment. This is why I always say you have to be careful with debt because the leverage works both ways. It magnifies gains and losses, no different than in the stock market. Now, on the topic of stock market, let's talk about margin loans. In the stock market, investors can use a margin loan, which are loans from a brokerage firm using your investment portfolio as collateral. A margin loan allows you to buy more stock than you have cash for. So let's say you have $50,000 and you get a 50% margin loan, you can buy up to $100,000 worth of stock. If the market goes up, your gains are doubled. But what happens if the market goes down? The brokerage firm can issue a margin call demanding that you deposit more money or sell your stock to pay back the loan. And if you can't, they will force you to sell your positions at a loss, often wiping out your entire portfolio. I'm only going into this because I think it's nice to have the information, but margin loans are a very risky form of debt and are best left to very sophisticated investors who have a high tolerance for risk and understand the markets that they're trading in. Ultimately, whether you're an individual or an investor, debt is a tool. You can use a hammer to build a house or to smash your thumb. The hammer isn't good or bad. It's just a tool. The same applies to debt. This conversation on debt is so important because it's a constant force in our financial lives. Understanding it is a key step in taking control of your financial future. We've covered everything from the good and bad uses of debt to personal management strategies and the risks of leverage for investors. Now, before we get to the outro, we have to do our listener stock picks, my second most favorite part of the episode. So this week we had a submission from a new listener, Jason. Thank you, Jason, for joining the podcast and joining the competition, who sent in a long position on Roblox, ticker RBLX. Jason's timing looks excellent so far. He initiated his long position on Monday, September 8th at a price of $128. As of our recording this morning, the stock is currently sitting at around $132, a nice quick pop for his portfolio. Now, a quick story on Roblox, a personal story. A friend of the podcast many months ago bought Roblox at a dirt cheap price and was holding it in her father's portfolio of other stocks. Unfortunately, due to some questionable advice, she was advised to sell that position a little early. I'm not going to disclose the price here, but when you're trading, guys, make sure you have your stop losses and have your exit levels, and also always hold on to a little bit in case something runs wild. And you never know what's going to be a 10 bagger, 50 bagger, or 100 bagger. You never know. So you always want to hold a little piece. Hold that last 25%. If it's 100 shares, hold 25 shares. If it's 100,000 shares, hold 25,000 shares. That's the lesson from that story. I'm not going to reveal the name of our friend of the pod, but better luck next time. And I can't wait to hear more stories from you. So back to Jason. Jason will be watching this position in the coming weeks, and we'll check back to see how it's faring. That's all the picks we have to discuss for this week. Please keep those submissions coming in on all social media platforms. We love talking about these real-time market moves and appreciate all of your input. Folks, that's it. Quick and sweet today. Thank you so much for joining me on Trajecta Talks. I hope this discussion has given you a clearer, more nuanced understanding of debt. Remember, the journey to financial freedom begins with a single step, and that step is knowledge. To stay connected and continue your learning journey, be sure to follow us and our sponsor, Trajecta University. You can find us on Instagram, LinkedIn, and Facebook by searching for Trajecta University. That's Trajecta University. Also, check out our YouTube channel at Trajecta_Talks, where you can watch this episode and find a ton of other great content. All the links are in the show notes for you. Join me next time as we continue our conversation about building your financial future. And until then, keep learning, keep investing, keep watching the markets, and keep building your future. Have an awesome Friday. Take care, folks.